Hello, everyone, and thank you for joining us today on the Dairy Signal. We're going to be diving into a market update here momentarily. But before we do so, we have to recognize our current sponsor for the Dairy Signal and all the support that they're providing for us to be able to offer educational programs like this one to you wherever you are at. And so a huge thank you goes out to DMI, Dairy Managers. I was going to go Dairy Managers Institute because that is one of our programs we have. And so I am just fumbling my words today. So apologies, but DMI, your dairy checkoff, very different from the program we have coming up at the end of the year here. But your dairy checkoff, DMI, they are at work building sales and trust in dairy through restaurant, retail, and food service partners, including youth outreach, research and product development, and much more. You can learn more about how they're making every drop count at dairycheckoff.com. So huge thank you once again to DMI for their support of the Dairy Signal. I have to say, if you are joining us maybe for the first time, hopefully not, since we've gotten this new little program going on, or this new facelift, if you will. But if you're new, maybe trying to figure out where can I ask my questions, it's very simple. You just look to the bottom right-hand corner where the three little dots are, click on that, and they'll say ask a question, where you can ask your question and submit at any point in time. It does ask for your name, but if you don't feel comfortable putting that, you can put anonymous, you can put question mark, whatever you want. I'm the only one who really sees it. So with all of that being said, if you have any questions throughout today's program, please make sure to ask them. But without further ado, to get us kicked off and get us started here on this Thursday afternoon, I'm going to hand it over to Ben Buckner from Ag Resource Company.
Well, thank you so much, Amber. Always such a pleasure to be a part of the Dairy Signal, and we will jump right into it. So, milk markets have jumped, and we're up again today, and I think that makes good sense. We did not think it was all doom and gloom and straight to the bottom, especially in the months of July and August. It's a little too early to be terribly bearish with milk. It's based on seasonal trends. And so something we highlighted a couple of weeks ago, and this is still the case, the world is awash in milk. Supplies are abundant. We are growing the U.S. cattle herd, mostly because of the spine of the U.S., Texas, South Dakota, some select places in the Central Plains. Yields return, places like California, so there will be no shortage of raw milk anytime soon. And most likely we continue this expansion in calendar year 2026. So you kind of see just every month we get the USDA's milk balance sheets. Those will be getting looser, not tighter. At the same time, though, world demand for dairy and U.S. milk disappearance is very, very strong. So even, 5 days ago, looking at, class 3 milk at 17 and a half, there's a lot of money to be made at that price. So I think the break enticed end users and importers worldwide, and that's why we're up. So I think we've kind of established the range that we're going to see through the end of the year. We like selling rallies, though. That is still the case. So we'll be very clear in communicating. I think it does make sense to hedge spot and forward production as you get further recoveries in class 3 and class 4, and especially target or think very hard about sort of Q1 or into April of 2026. And we've highlighted this now for a couple of years. It is very normal seasonally for markets to collapse kind of between the Dec and March or April period. So let us avoid that. You're being given a pretty decent margin today, decent price, but you only get that price once you make that hedge. So that's something we really want to communicate to the dairy operators is think very hard about that. But jumping in, we have found support, the October contract, at sort of spring lows about just over $18 a hundredweight. We kind of recover from that. And I think that does make sense. We neither needed to be at 19 and a half nor at $18. 18 was too cheap, 19 and a half maybe too expensive. And so we're caught in between. So you can see that we really, since fall of 2024, volatility has defined the market. And I think that's still going to be the case. You don't have guaranteed oversupply just yet. And a lot of what we're producing in terms of growth, both here and in places like Europe and Oceania, is being absorbed pretty quick by the world market. So, again, it's very simple to us, at 18 or below, end users, importers are just making a lot of money, making a lot of margin. So those are your downside targets. Your upside target's probably just a little over 19. Just wanted to highlight that, the market's appropriately rebounded in the last couple of weeks. And how high is something we all need to determine, but we want to be very cautious given The runway for what is normally a pretty seasonally bullish time in the dairy space is running short. So highs are typically made the very early part of autumn. Let's call it the first 10 days of October. That's still many weeks away, but it's farther away than it was 2 months ago. So it's being cognizant of that. And I think the demand for milk as a whole, dairy products, and also this kind of newfound strength we have seen in, whey and non-fat dry markets has kept pretty decent premiums intact when we're thinking about all milk cash prices and milk checks. So officially in the month of June, the national all milk cash price was $21.30. That was unchanged from May, about $2.60 above, June class 3 settlement. And they're not always guaranteed to be premiums in the cash market, but it's something that we have seen by varying degrees over the last 4 or 5 years, really. And that's still in place today. And I think stays in place for the foreseeable future. And if nothing else, I think it is, a tightening whey and non-fat dry market, but also just the world's demand for fat is insatiable. So class 4 premiums also, I think, stay in place. But we kind of do some pretty simple arithmetic by looking at, CME prices and looking at the recent premium in the cash market. So I would kind of plan for the next couple of months, milk prices nationally and in Wisconsin, between $19.80, $20.50, something like that. And I think what the market is telling us is that will probably be the cash milk price into November, maybe into December. So historically, it's pretty high. It's, not as high as we would like to see it, like we've seen it, last fall and the previous couple of years, but it's a decent price. I just don't think it really moves much for the next 4 or 5 months. So thinking about your P&L's balance sheets, kind of plan for something like that. I also think the USDA's national price cash forecast, about 22 in the ballpark, maybe 30 cents too high or too low, but that is probably what we're dealing with when we think about calendar year cash milk prices. Very quickly, we'll touch on something we've touched on really the last 2 or 3 dairy signals, and that is supply. It is not insightful to say that when we do see milk production growth, cheese production growth tends to follow that. That is exactly what we're seeing, though. And the increase in cheese production, from very low levels, has been pretty remarkable. Cheddar production in the month of June was 330 million pounds, up 6.5% from last year. Fourth consecutive month that production has grown by more than 5%, which historically is pretty robust. So again, lots of milk available. That will continue to be the case. And I think those processing plants that we know have expanded capacity will follow suit. And there will be a lot of cheese produced in the U.S. second half of 2025. Butter production was 185 million pounds compared to 168 million a year ago. So up about 10% and a record for the month of June. So we're increasing butter supplies, and we'll kind of touch on, the world butter market is still $3.50 per pound. The U.S. market's $2.45 per pound. That discrepancy is not bearish, but also why isn't the U.S. market going to meet the global market? And I think it is because of this, because we have really no shortage of supply. There is no need to ration it. Unlike, say, 21 and 2022, where you weren't producing enough and demand was incredible, you had to ration supplies. Not really the case in the U.S. this year, though it is seemingly still the case in every other exported country. And also, this is, I think, the most interesting thing that's developed in the last 2 weeks since we last met. China is back, and back, I think, in full form. So thinking about just the evolution of the trade war since, January, February, our biggest concern to the milk space was not even that we were seeing cow herd growth. It was, does China leave the U.S. dairy market? They are our third largest customer. And I still think it is the case. I don't know where else they'd go to get dairy products because, New Zealand and Europe aren't especially robustly supplied with something like cheese or whey today, but they did leave. China kind of put the screws to the U.S. or the imports of U.S. stuff, and imports collapsed in April and May. So the U.S. exported, of all dairy products, in May, just 11,000 tons of supply. But in June, they exported 43,000 tons of supply. That is the 7th largest for any month ever and 2nd largest for the month of June. And you can see pretty clearly here the snapback that occurred. So that I think that starts to explain why class 3 does find support at 17 and a half, because it got cheap enough that China was willing to fill its reserves, which it needs to do with the U.S. product. I also think this kind of follows oddly closely the details of tariffs being volleyed between the U.S. and China. So, March and April especially, and into May, tariffs, U.S. goods going to China 155%, which the ag market, especially the things that we export, we're not as concerned with what the U.S. is doing. We're concerned about retaliation and what other countries are doing to our products. But in April and March, there was a 125% tariff on U.S. goods going to China. So even, let's say, everything's free market, the importer there was losing money importing stuff from the U.S. And so I do think shifted to places like Germany and New Zealand. But those tariffs now, at least today, this could change in any day or any week, but there's only at most a 25% tariff on U.S. ag goods going to China. So I think that is small enough that the Chinese importer is willing to take a stab at buying U.S. products again. So anyway, just thinking China is only out of the U.S. space, and this is very important when tariffs are prohibitive on their side, and that's not the case. We're probably going to extend negotiations with China at some point this week for another 90 days. So I don't think a deal will be done to buy U.S. soybeans, for example, which is concerning. But as long as China is willing to keep, tariffs on dairy products at no more than 25%, given the tightness in a lot of other world markets, I think China probably will buy an adequate amount of U.S. dairy products. So I think this is important. This is why Class 3 October found pretty decent support at 18, because, again, a lot of people are making lots of money. Margins are expanding at cheap prices, and also importers are finding these values attractive. Total dairy exports as well, because of China's return, but also non-China expanded as well. Total exports, all products combined in the month of June, was 245,400 tons, up 15% from last year, a record for the month, and like shipments to China, sort of the second largest for any month ever. Notice also this is kind of bucked seasonal trends pretty significantly. I mean, this is a pretty special number for the month of June. And I think once this came out, I know this only explains what happened, 60 days ago, and purchases made, 90 or 100 days ago. But I think this is new input for the Class 3, Class 4 space this week. Exports are very, very good. The theme being this is absorbing a lot of the extra milk that we're producing. And I think we'll continue to do so. Again, we'll take a look at the snapshot of where the U.S. dairy markets sit compared to others. It's still very, very attractive. So anyway, this incredible expansion to China, total exports, and even non-Chinese exports were up 23,000 tons from last year in June. So everyone does seem to be finding value in U.S. dairy in general, but especially if you break the Class 3 market or the cash product markets, those are only going to entice additional forward coverage or additional demand from end users and imports. And I think that's important. Cheese exports typically peak March. We have seen the opposite of that occur. And something that we've highlighted is, again, Class 3 cheese cash prices will find fair value on a daily, weekly basis. And the additional supplies of milk, have been weighty on the market. At $19, $20 Class 3, bearish even. But again, we're making a lot of this stuff disappear. So cheese exports, all varieties in the month of June, 52,000 tons, a new all-time record, and up 34% from last year. No seasonal downtrend from May to June, or even from March to June. We exported more in June than we did in any month previously. So I think that is telling us that, most importantly, cheese is competitive in the U.S. Cheese is outright cheap compared to markets like Europe, especially. And so that is translating to pretty incredible export disappearance. And so that is still the case today. I think U.S. cheese exports are going to remain strong. Butter exports outright were 8,800 tons. Net exports were about 4,800 tons. That is the second highest for any month, or the highest for any month since late 2014. Imports too. So we're just starting to see, economic theory play out in real time. So one of the things we've highlighted is European butter, until now, pretty close to $4 per pound. That includes Kerrygold from Ireland. And there's been a lot of consumer preference for Kerrygold, kind of no matter what that relationship is, until it gets past a certain threshold, which I think we crossed the early part of this year. Imports of Ireland are down to, 58,000 tons compared to about 4,600 tons in January. So we're importing a lot fewer tons from Ireland, even if people like carriole, they don't like it at this price. So we're shifting things around pretty significantly. I think that's important. Again, exporting the most butter since 2014. It's just kind of a unique marketplace. And like cheese, thinking about cash markets, if U.S. butter is cheap, we're going to export a ton of it. U.S. butter today is still very, very cheap. So I think we're going to have positive bars on this graphic, probably indefinitely. And so that's adding 3 to 12 million pounds to monthly disappearance. And just a big shift that we've highlighted before. A year ago, we were adding 7 million pounds to supply. So this is kind of a shift of upwards in 20 or 25 million pounds per month. So it's very hard for us to be bearish of butter at these prices if at these prices we're finding a lot of export demand. And price, broadly speaking, is set in the export market, that marginal market. So I think butter at 240 has a lot of value, at least until we get into Q1 2026. The balance of dairy trade, $428 million positive versus $398 million in May, and about double what it was in June a year ago. So it's been really good for the industry. Just the shift that has occurred has been pretty remarkable. So we saw, late spring, early winter, U.S. stuff is cheap, finding export demand, but that has really been exacerbated recently, and especially maybe just something like the U.S.'s not agreement with China, but the two sides agreeing to sort of cool tariffs for now, at least, translate into pretty big time U.S. dairy demand. So we are hopeful that, I guess, practically speaking, China will not raise its tariffs on U.S. goods, but also any kind of deal, any kind of cooling or thawing of tensions does bode well for cheese exports, for whey exports globally. So that is our hope for the rest of 2025. But you can kind of see how immediate all this stuff happens. Worsening relationship with China, bad for dairy prices. Improving relationship with China, very good for demand and very good for price. So that is the goal if we can get something sorted out. So we kind of take a look at everything. We can kind of now back into what we actually consumed in June, and it was pretty robust in the case of butter and pretty solid in the case of cheese. So we can get through production stocks. All butter that was made to disappear in the month of June was 201 million pounds. That is up 19 million from last year. In January to June, butter disappearance, 1.18 billion pounds, up 8% from last year, which was also a record. So again, talking about this insatiable demand for fat globally, still very much intact. I don't know if we can sustain this kind of growth every year for the next decade, but it is something that we have seen, the global butter market getting pretty tight because of demand and just our inability worldwide to produce much more than we consume. I think that will be a theme for the next couple of years. American cheese disappearance, we estimate at 477 million pounds, up 4 million from last year in that month. Jan to June demand up, or 2.89 billion pounds, up 15 million from last year. So demand still very, very healthy, we think. And looking at the case of butter, and this is something we've talked about for the last couple of years, is I think cash markets and so futures markets are pretty simple. I think they're pretty short-sighted, and peak demand still to come. Between September and November, we are going to use so much butter. I think that we probably can't say highs have been set in the market, but certainly it is very hard for class 4 butter and fat prices to drop until you get to maybe October 1st, October 15th. The end user has sorted out the coverage they need during and ahead of holiday baking season, but not until then. We don't know exactly how much butter we're going to use, but it's going to be a lot in the first half of autumn. And again, kind of an aside, I think why we're sustaining these premiums to the class 3 market in the cash milk space is this sort of quietly tightening whey, and maybe more important, the non-fat dry production. So this is mislabeled, but whey production in the month of June, 74 million pounds. Consumption was 75 million pounds, and so we lost another million pounds of stocks. So now stocks of whey on June 30th, 58 million pounds, down 9% from last year. So very, very quickly getting tighter. Most likely we follow the trend of last year, and so we probably don't outright bottom whey inventories until September or October. Whey price keeps going up a penny or two almost every week, which is seasonally normal, but that does add value to a volume of raw milk. The whey market will participate. Non-fat dry production failed to match consumption, and by 9 or 10% for a second consecutive month. So Non-fat dry stocks were down in June. Another 13 million pounds are now down 13% from last year. And almost every year, the non-fat dry market tightens further seasonally between July and September and October. So I don't think we've seen the high yet in the powder market or the whey market. So it's not the biggest component, but I think it does provide a pillar of support, certainly to cash milk prices, but even to class 3 at the Board of Trade. It's just hard to sustain breaks. Again, I think until we get to the early part of the baking season. And that's why I think that runway, though, is what it is. Let's leverage this next couple of weeks into hedging Q1 milk production. And that's why we're saying what we're saying. But in terms of demand, I don't think it goes away. So again, this is as of last week. The difference between the red line, the U.S. block market, and everywhere else still kind of noticeably wide relative to the last couple of years. So as of last week, New Zealand cash cheddar was $2.14 per pound. A little bit weaker of a trend. 2 weeks ago, we highlighted this kind of surprising jump in New Zealand milk production, and seasonally, they're about to increase production even more. They peak milk production in October, kind of getting their way starting in August. The Western European cheddar, $2.44 per pound. The U.S. market, about $1.70 as of last week. So you still have this, 45 to 60-cent discount in the U.S. cheddar market compared to our competitors. That is really unchanged from where it's been the last 6 months. And in fact, our discount to Europe is the largest it's ever been. Europe is the largest exporter of cheese when we look at their market share. So I think we're going to see pretty strong cheese exports for the rest of 2025. Again, just kind of tough to be overly bearish until you get into Q1 2026. So overly bearish of class 3. And butter looks similar. So New Zealand butter, as of last week, unchanged from the middle of June at $3.43 per pound. European butter, $3.84 per pound. The U.S. market, $2.45 per pound. So again, it's pretty clear that once you cross this threshold that we did in February or March, things start to change in terms of where consumers buy from, what U.S. net exports or imports are. We are exactly at the same ratio that we've been at for the last 90 days. So I suspect we're going to continue to be a net exporter of butter, 6 to 15 million pounds or so for the rest of 2025. Maybe this starts to slow October, November, but not before then. So again, just wanted to communicate that while we are not concerned, but the U.S. is producing a lot more milk than last year, and really in the history of time, demand will be there at these prices at least. So it's kind of the counterbalance to this pretty incredible expansion of milk production. So kind of in the end, this is what we think is, even just adding up or averaging cash prices to date, what we presented, what we think will be the next 3 months, $19.50, $20 all milk cash prices. USDA is about correct. I mean, you kind of come up with maybe a 21.80 if the market stays exactly where it is for the next, 4 or 5 months. But pretty close, a pretty historically high cash milk price. So again, kind of plan appropriately, about $20, 19.50 cash milk for the next several months. But in the end, this will be, the 4th highest cash milk price ever. And I don't think that gets disrupted maybe until next year, when perhaps we start to collide, sustained expansion in milk production in Europe, Southern Hemisphere, also the U.S. Things could start to look differently, but I think for the short term, we're kind of locked into these prices. What is unique, and again, what we think the silver lining to not having $22, $24 class 3 milk is the feed market outlook to us is still fairly bearish. And as we'll talk about, it's not just the market doing what it's doing now, thinking about corn and wheat and protein meals. That's very easily explainable, and I will spend too much time explaining that in the next couple of minutes. But kind of the duration that corn stays cheap and that soybean meal stays cheap. So with that said, we want to think about, even 17.50 class 3 forward the second half of 2026. Compared to what could be cash corn prices of, $3.50 to $3.80 for the next 12 or 18 months. I mean, that margin is not terrible. Let us entertain locking in that margin when and where possible. It's just something I want everyone watching this to think about. But we do think the milk feed ratios get wider, at least for the next 60 days or so. And already they're above average, especially the soybean meal to class 3 to soybean meal ratio. It's going to stay very wide. It's very hard for us, really physically hard to clear all the excess meal supplies that we have currently and will have in the future. That probably doesn't change, but also, the corn market. We will talk about U.S. weather, yield potential, the special nature we think of this growing season, but also everywhere else, other feed commodities as well. I don't think the market's quite digested the sheer impact of that. The impact of it raining more than expected in the second half of July in Ukraine and Romania. That is on the other side of harvest, I believe. But it is no secret that, weather's been not bad. The nuance of corn and soybean yields still yet to be determined, but I wanted to present the scenario and why you're seeing a lot of private yield estimates that, while maybe sound absurd, I think are mathematically feasible. So we look at July 1st to August 6th, percent of normal rainfall in the principal corn belt, which you see here. It's really hard to identify major problems outside of Michigan, which according to crop conditions, is not doing great. Maybe Northeast Indiana. Everywhere else, I think an abundance of water. And even in places like Kansas, I think a lot of this medium-term dryness gets solved in the next 10 days. People we talk to there say potential is still very high, but it's that Iowa, Nebraska, South Dakota, Minnesota, and maybe Wisconsin, I think have a lot of potential for some pretty incredible yields. And so when we think about physical cash corn supplies on October 15th. First keep in mind, we planted 5 additional million acres of corn this year relative to last year. But also just think about irrigated crops in Nebraska and Kansas, yields coming close to matching irrigated crops. That is a big deal mathematically for national corn yield. So you kind of start with that, and then you think about just the garden state nature of weather in Iowa this year. Could we have a 220 statewide corn yield in Iowa? Again, we will get into the nuance with crop tours, USDA objective yield data, but I think that is mathematically possible. And just thinking about, dry land crops out in the West doing well, Iowa harvesting 220 bushels of corn nationwide, that alone gets you to about 185 bushel national yield, if we just assume something close to trend everywhere else. So that's the starting point here. We also think about vegetation health. I know that does not get you precise in terms of yield estimates, but it's very, very good. And for the most part, above last year. The USDA will release its August crop report next Tuesday. And so the average trade estimate for corn yield is 184 bushels an acre, up 3 from the USDA's current estimate, which makes sense. I am not going to dismiss that as a yield forecast at all. But a year ago, given pretty decent weather to date, the USDA forecasted yield in August at 183.1. So if we're only adding 9/10 of a bushel, despite what we've seen in Nebraska, Iowa, South Dakota, Minnesota, is that a little too low? Again, at least for the August yield, which is kind of satellite-based, survey-based. We will get nothing in terms of objective data yet, but just thinking about crop ratings this year to last year, vegetation health, et cetera, could just see a 185 or 186 on Tuesday. That by itself will add 300 to 500 million bushels of supply that the USDA probably can't make go away in a different category, so higher stocks estimates is the thing. But also, when digging into vegetation health, it's no surprise that this normalized difference vegetation health index, NDVI, it's what we use to measure at least the way crops look. I know that is different from the weight of the fruit that those crops produce, but it's a starting point, especially for August. So as of this week, and actually any week, vegetation health in Iowa is the highest it's ever been, which makes sense. They have had an abundance of rain, no real sustained heat. That is fine. The Eastern Corn Belt, though, I think it would make sense if they were to do a little worse. They have gone through some bouts of heat dryness. It hasn't rained as much in places like Ohio, Indiana. So checking in on vegetation health in Ohio, though, I was surprised to learn that it, too, is by far a record for this particular week, and actually a record for any week. Relative to average, Ohio is doing better than Iowa. So again, I don't know what Ohio's corn yield will be, but it's just hard to identify a state. Seemingly, no matter what short-term weather has been, vegetation health looks very good. Does that set the stage for something? Crop ratings too, and a lot of people have been publishing crop rating-based yield forecasts now for 4 or 6 weeks. Of course, they get more accurate as you get closer to September 1st. But it does seem like whatever these are worth and however the enumerators from NASS calculate these, it's telling us something. So what jumped out to us, 2 or 3 weeks ago was that corn and soybean ratings were increasing counter seasonally. That's something you typically only see in years like 2016, 2018, then record yields, at the time. But also compared to last year and normal. So the US corn crop, 73% good excellent. On average, first week of August, it is 65% good excellent. I believe this is the seventh highest rating since the system started in the late 80s. Soybean crop rating, 69% good excellent. Average is about 63% good excellent. So again, I know there's more nuance to this, but we're kind of putting a story together as we approach, especially the August crop report, but maybe even the September crop report. And just thinking about, can USDA in their methods as well, print something below 185 bushels for corn or below 53 for soybeans? Because when we look back at history and just, again, we're trying to provide some scaffolding to risk management, how big is big in terms of crop production in the US. Let us just take every year corn's been rated, 73% good or excellent as of the first week of August since 1990. That's what you see here on the left. How did corn yield in the end perform relative to trend? And you can see it's anywhere from 3 to 15% above trend. I don't think 15% is reasonable just because we're already at a very high level. It's going to be more, marginal growth is going to be more challenging, but I think you can add 2 or 3% to trend. That also aligns with the biggest changes we've seen from year to year. And so, a corn yield 3% above trend is about 186. Again, for context, USDA today is 181. So we're adding lots of bushels to the balance sheet most likely. Soybeans too, let's take years that the crop's been rated at or above 70% good excellent, similar to this year. Final yields 1 to 18% above trend. That's anywhere, from 53.5 to 58 bushels an acre. Let us dismiss the 10 to 15% improvement from trend. But if soybean yields 2% above trend, that is about a 53.8 bushel an acre crop. That adds about 100 million bushels to the balance sheet. Can we get China to buy that? That is sort of, I think, why soybeans have been the weakest the last couple of weeks, because the market is, at least the math today, looking forward to USDA raising estimates, raising in stocks. China today has not bought 1 bushel of soybeans from the US for new crop delivery, which is pretty unique. So let us exclude the current outstanding soybean export sales and just focus on what the exporter in the US has sold, in the last 2 months or so for delivery after September 1st. That is what this graphic shows you. So it's only 111 million bushels, the smallest since 2005, and really different from a lot of years, except for the last couple or the trade war of 2019. I think China will be forced to buy something like 12 or 14 million tons of US soybeans between October 1st, February 28th. But in the same period a year ago, they bought about 18 million tons of US soybeans. So again, if you don't solve this US-Chinese trade war, I think soybeans will be kind of the principal collateral damage. Longer term, could you cap soybean exports at something like 1.5 or 1.6 billion bushels? That is 175 million below the USDA. So that you're starting to shift US soybean supply and demand because of weather. Again, just want to communicate that China seems to be playing hardball, at least with the US soybean space. They have bought nothing. We can see pretty easily what the cash price of soybeans is in Argentina and Brazil if you wanted to buy it and you're an importer. We can see that in the US today. It does appear, well, I think it's a fact, China is buying more expensive Brazilian and Argentine soybeans just because they are shunning completely the US market. How long they can do that, I don't know. Again, I think they do come back to the US market, in the middle part of autumn. It's just, we would like to have that runway be 1 or 2 months longer, but we're already cutting into that. Again, I think in 2022, we had sold 550 million bushels of new crop soybean supplies as of the first week of August. That's just not, I'm sorry, late July. That's not the case this year. I talked about sort of what's on the other side of it. So again, everyone can see and feel crop ratings, yield potential, kind of the heaviness of the balance sheet and of cash markets during the autumn months. But we're kind of moving past this. We don't know exactly what yield will be. It'll be very big. It probably will be at least 184, 185 on corn. It's going to be a pretty heavy balance sheet. So the question is, how do you get rid of this stuff? How fast does that occur? You tend to rally grain markets seasonally after about October 1st, October 15th. But what does that recovery look like? And thinking about a year ago, it was very swift and it was very robust. I mean, in a matter of 5 months, we went from $3.60 corn to $5.20 corn. I think it will be harder to repeat this, even ignoring the entirety of geopolitics. A year ago, we had what was pretty major disruption to supplies outside of the U.S. Brazil's crop was about 10 million tons less than expected in the end. Ukraine experienced crippling drought, as did Romania. So no one else really had any corn. So corn export estimates went from 2 billion bushels to what will end up being a record 2.8 almost. We exported the most amount of corn in this crop year that we've done in the history of time. I don't know if we can repeat that again. And some of that's already built into the USDA's balance sheet anyway. So what you're looking at here is kind of the corn-heavy areas of Europe and the Black Sea region. We highlight Romania, kind of the northern half of Ukraine. This is rainfall, the same chart that we saw in the US, July 1st to August 6th. Not everything is perfect in Ukraine, but I think a lot of places are doing pretty well. Romania also doing pretty well. You assume trend yields in both countries, all of a sudden they have about 7 or 8 million tons of additional corn supply this year that they didn't have last year. They're probably going to be willing to sell that to North Africa, the Middle East, come November 1st. So we're going to have a lot more competition for U.S. corn demand. Then we're already competing with South America today. So it's not just what's happening in the U.S. Again, we're thinking about the other side of harvest and what that means for markets and risk management. And so kind of putting it all together, we think about, what's probably going to be presented in the next 2 or 3 months from the USDA in terms of supply and demand. And we think ending stocks, the risk to the market is that they will be 2.4 billion bushels. So there are a lot of numbers here. We think the USDA is about right with its old crop carryover. Maybe they take down ethanol a little bit. That is offset by higher exports. Assuming 185.7 bushel an acre yield, which may be too low, we will get into that in the next 60 days. But because of competition for export demand, we think the USDA may be 2 or 300 million bushels too large. That keeps ending stocks, pretty close to 2.5 billion bushels. Again, that's being digested. This is being pretty rapidly priced in by the market. But what I want you to think about, again, in terms of, if you're a producer, forward carries in the market, risk management, or if you're a dairy operator, thinking about the sort of landscape of the feed market space over the next 12 or 18 months. I don't think, while we may bottom corn in the next 30 days, it's going to be hard to really get a significant recovery in the market. I think especially the cash market in places like the Dakotas and Northwestern Corn Belt. So let's take it a year out. Let us assume that we're carrying over 2.4 billion bushel in stocks. I think the market's telling us, and because of biodiesel policy, maybe, we need to cut corn acres. So let us cut off 4 million acres, put those into soybeans. We assume trend yield, kind of trends in consumption, even some modest export demand growth, and we're still left with 2.2 billion bushels. So it makes you think, we're kind of crossing this area where we are in a market like 2018, 2019, where volatility is gone. You were stuck in about a 30 or 40 cent range for 18, 24 months. That, I think, is one of the principal risks that we're staring at right now. But like I mentioned to the producer, you still have these incredible carries in the market. December 26th is pretty close to $4.50 today. If there is not a problem in South America or in the U.S., 40 to 50 cents of that premium will go away by the middle of next summer. So we do like being active in hedging markets, using forward premiums, modest recoveries. I think those are places to get things done. But anyway, the point here is that for the next 2 years, we can't really drop U.S. corn in stocks below 2 billion bushels. It's a pretty well-supplied market. Soybeans as well. If we shift those 4 million acres into the soybean market, we think we're going to carry over about 490 million bushels. Assuming trend yield, trends in consumption, let's say China to some extent does come back in the 26-27 crop year, you're still left with about 650 million bushel in stocks. So soybeans turn into a $9 to $10 market for the next 18 months. So crush margins will be very good because of oil, and so we're producing a lot of meal, but the bean market by itself, I think, does face some measure of oversupply if there is not a South American weather threat. So again, we think the soybean yield this year will be very high, stocks will be adequate, but again, what's on the other side of this is where we're turning our research to. And just generally speaking, outside of, to some extent, butter, milk, beef, pork, it's hard to identify kind of inflationary trends in really the raw material space as a whole. We've seen stagnating grain import demand. Trade is the best measure of what's actually happening with demand. It's been really lower for 2 consecutive years in corn and wheat. Soybeans have plateaued. The sort of core of China's protein demand, the hog market, just has done nothing for the last 10 months or so, to the point where spot hogs, about 13,500 yuan per ton, have avoided what is usually a pretty seasonally bullish time of year, July and early August, but it's still doing nothing. So I don't think this is telling us China needs a lot of imported supply. I think they're trying to reduce the size of their hog herd. But I wanted to show this just as a big picture thing. Even crude oil can't really get much above $70 a barrel. Protein markets worldwide aren't doing much outside the U.S. Rice is kind of flirting with a multi-year low, the world's principal feed grain. So just want to identify we're kind of in stagflation when we think about grains specifically in the world ag market, I think more broadly. So thinking about feed, again, the other side of this. So again, we'll don't really care exactly what corn yield is. It's going to be very high. How high is what the market's left to determine over the next couple of months. But it's everything else. How do you get rid of corn if Ukraine's crop is up, if Romania's crop is higher? We already know Brazil produced about a record crop this year. Cash corn and sorghum this week is $2.95 per bushel. On the left, you can see basis. This is in Hays, Kansas. 92 cents below September Chicago corn. And something has happened. The sorghum market is imbalanced. And we planted about the same amount this year as last year. They are benefiting in Kansas from the same weather pattern everyone else has. I think yield will be very high. Cash hard red wheat in western Kansas, Garden City, $4.35 a bushel. And so Plains feed yards are going to have, I think, ample opportunity to kind of switch rations up when possible between sorghum, corn, DDGs, soybean meal. All of it's pretty deflated. So who wins this contest? Just competition for demand is never supportive of price longer term. There's just going to be a lot of feed stuff in the central U.S. We take a turn to the rest of the world. Who's growing crops next? And let's talk about wheat, just as it pertains to corn, things like rice. The weather that matters most in determining wheat yields in Australia and Argentina, both pretty big exporters, is weather from about August 10th to October 1st. Here we're looking at July 1st to August 13th. % of normal rainfall in both of those countries. This assumes kind of the 5-day forecast is correct, but also an abundance of water. And this is a little earlier than normal. We're rejuvenating soil moisture in the wheat producing areas, which are highlighted. We're not in either El Nino nor La Nina, and I don't think we will be for the foreseeable future. So most likely wheat production in the Southern Hemisphere will be pretty robust, or trend yield, I think we all have to assume. And the math there is that they will have as much wheat next year as they do this year. They're going to be pretty sizable exporters. The Australian Bureau of Meteorology is the best at telling us or forecasting whether La Nina or El Nino is imminent. And this is their latest forecast published on August 2nd. So very boring, almost exactly normal equatorial Pacific Ocean temps. And the reason I'm showing you this, first we take weather 10 days at a time, but we kind of start to provide some frameworks to places like Argentina and Australia and Southeast Asia, even southern Brazil, just because a lot of the climate pattern there does hinge upon the temperature in this small region of the Pacific Ocean. Normality there kind of foreshadows normal weather patterns. So I think you probably get into the latter part of 2025 without any major issues in Argentina or Australia. Argentine wheat is up next, but they start to plant corn about October 20th. Do you just assume a lack of supply dislocation in the South American corn market? And so we're building upon this. So if there is not a weather threat, I guess in late August in the U.S. or in the southern hemisphere between November and February, you're only adding to global grain stock. So again, what's on the other side of this kind of yield-based supply pressure we've seen at the Board of Trade recently? But bottom is due. Like I mentioned, it is still, no matter how high your yield forecast is, it is tough to be bearish of corn beyond about the first week of October. Now, how low is low? That is yet to be determined, but I do want to point this out to the dairy people in that this is going to be, I think, a pretty good year for milk feed ratios, but we do like locking in those margins prior to October 1st. And also wanted to communicate over the last 10 years, most often the Chicago corn market has bottomed in August. Thinking about people being forced to liquidate all remaining old crop contracts, that is usually more often than not kind of the driver of when Chicago corn bottoms. So again, most often the bottoms in October, though we have seen years in September, October, but just wanted to plant the seed that it may happen in the next 30 days. So be aware of that when we're thinking about forward feed coverage, forward feed costs, and so on. At the same time, again, like I mentioned, as the market bottoms, that is one thing, but again, we're kind of crossing this threshold into replicating markets, between 2015 and 2020. This is, again, without a weather threat, this is probably where we're heading. Just kind of very boring, deflated. The markets do nothing for 12 months, 36 months. So again, I think that while we're willing to entertain, corn supply hedges, mill supply hedges at current prices, I think the other side of this is that, do you lock in $18, $17 class 3 for the second half of 2026 if we are thinking the corn market stays where it is? And if there is downside risk in the forward milk market just because the U.S. is producing so much. So there's a lot of things to think about. I just think that clearly one of the themes that we've got here is looking at margins, taking some action, doing something. Protein meal is similar. I think we're probably close to some kind of bottom in the meal market, but to get this thing much above 300 or 320 a ton, going to be very difficult until we maybe just stop the renewable diesel production growth, and that's probably at soonest a year or two away. So thank you for your time as always. The ideas, the summary is, between now and November, I think milk prices do fairly well. Feed markets have yet to score lows, but again, think about locking in margins between now and certainly Q1 2026. Questions now welcomed. If you have anything in the future, want to know anything about risk management, please don't hesitate to send me an email.
Well, Ben, we definitely do have some questions that have come through. So I'm just going to start from the top of them and work our way down. The first one here reads, our government has likely never experienced this type of speed in executive decisions. Does your firm have any insight in the topic on the area of tariff waivers? Companies who produce critical specialized products are not receiving the guidance from officials as how to qualify for these waivers. Is it possible that Congress will outlaw these tariffs?
It doesn't seem like it. Yeah, that's a very good question. And I think the correct answer is I don't know. I mean, this thing is moving very fast, like you said. I don't think if Congress were concerned about tariffs, they could have done it already. But it doesn't seem like they're willing to do it. I suppose, if it's about voting, midterms could change this. It's still many months away. But I think between now and then, we've got to deal with the uncertainty and kind of the changing and the evolution of U.S. trade policy. So a very good question. I don't know. I don't think Congress will do something unless there's kind of a sizable majority in both houses that Democrat. That's, I think, how you get some pushback against this.
Okay. Next question here reads, with China buying more U.S. dairy, is that mainly because it's best on the price and they need to resupply their stocks versus soy being so readily available in South America and not having to deal with the U.S.?
That is exactly correct. You explained it better than I could. Yeah, there's a lot of competition for soybeans. Thinking about Brazil's crop was the biggest it's ever been this year. Argentina just recently ended or reduced soybean and soybean product export taxes. So on the margin, it becomes cheaper. So yeah, there's been a lot of cheap soybean in South America. And so even up until maybe the last 2 or 3 weeks, soybeans in Argentina were cheaper than the U.S. So they were buying soybeans from Argentina. Now it may be a little more political in nature, but yeah, there's a lot of competition for soybean demand with the U.S. Milk, dairy is the opposite. We don't have nearly as much competition. So I think China buying U.S. dairy was price. I showed you the price spreads. So yeah, I think they were, let's assume that it's not even about the sentiment between the U.S. and China. But I guess if you had 125% tariff, well, at that point, U.S. whey is more expensive than German whey. If that tariff goes away, then all of a sudden whey is the cheapest again. So yeah, we don't have as much competition for exports in the dairy space.
Okay, next question here. Still on the export train here. It reads, how long can the U.S. sustain this level of exports, and do we have the supply for the foreseeable future? Will we see a big hit on milk price when either the U.S. price increases or global prices decrease?
I think I think exports stay pretty robust indefinitely. And we have kind of talked on the Dairy Signal about the nuance of Europe produced more or less this month, so did New Zealand. I think it's going to be hard for New Zealand and Europe, the two biggest competitors, to really grow milk production annually for the next decade. But I'm concerned about the sort of medium-term hit being, so far, New Zealand has been pretty resilient. They could produce a lot more milk, between September and January of this year. That would be unique. We haven't seen that for a couple of years. On the margin, that will harm our exports at least a little bit. And then that collides with, again, just having a lot of cows and producing a lot of milk in the U.S. So it's just, both of those get you to the place where there might be some liters of milk with nowhere to go for the first time in a while. That would be spring 2026. That is a time period I'm more concerned about in terms of risk management.
Okay, one more question, at least for now, on the export side of things. And it reads, since China has filled their dairy supply, do we think that they will steady out and continue buying U.S. dairy or drop off once again? Or is it too hard to tell given trade and tariffs?
Yes, the latter. It's too hard to tell. Though I think something that we've been paying attention to is, I guess, cutting through the noise. What we're concerned about in trade policy is the ag space, especially the things that we export, the things we export, especially. What is the tariff on the other side? So I think if China's tariff stays below 25%, then they're going to keep buying U.S. products. They just can't source. And I guess they've shown this now. We thought it was over, but it seems like they can only go 2 months without buying U.S. stuff, because it just would be hard to get it from everywhere else. I mean, you're only talking about certain countries in Europe that have a waste surplus. So, and China bought that. But now they got to come back to the U.S. market to get it because it doesn't exist. So I think that is probably the big thing. So I think China, as long as you don't see in the news, China places a tariff of 50 or 100% on U.S. goods, China's going to buy U.S. dairy. So and that's changeable. Who knows? But I think as long as the tariffs on the China side don't change, then they will continue to buy dairy. So that's the thing to watch.
Okay. And as of right now, the last question that we have reads, how is it that the U.S. dairy is now in an expansion phase when for so long we've been told that cow and heifer numbers are at an all-time low, but then all of a sudden we've got expansion and adequate milk supply? So Ben, read us in.
Yeah, that's a very good question, because even now it seems like, especially now, the beef market is telling you to grow those cows for beef. And this would be more anecdotal, although it is supported by kind of the monthly numbers. It's been, Texas, Kansas, and South Dakota. So part of it was recovering from bird flu, but I think that, those really large operations, 200,000 plus cows in places like Texas, can kind of turn on the cow spigot and the margin is there. And so I think we saw that, thinking about prior to, maybe the last couple of months, all milk cash prices at $22 or better. So I guess for whatever reason, to enough people, the margin was attractive enough to really step on the gas in terms of adding cows. And again, so it really just those 3 states that did it, but they did it. I can't explain why, but that is kind of what's happened. It's a very good question, and it did happen very quick.
Well, it's a very interesting time, especially in the dairy space when it comes to cow numbers, milk supply, and pricing, all of that. So,
Yeah,
interesting enough. We'll keep an eye on things. And as always, we're excited to have you back here in a few weeks to give us a little bit more insight. But for now, Ben, that is all the questions we have for you. So, thank you so much for your time here this afternoon.
my pleasure.
And as always, to those who are listening, thank you once again for joining us here today. And also a huge thank you as well, once again, to DMI for supporting the Dairy Signal. But for now, if you're ever wondering what is going on in the world of professional dairy producers, you can head over to our website where you can learn more about things like the Your Farm, Your Footprint initiative, as well as our upcoming technology tours in Wisconsin and ACE on the Farm Twilight meetings. So if you're in the area and you want to check some of those out or just interested in what else is going on, head over to pdpw.org to learn more. But for now, thank you for joining us, and we'll see you here next week on the Dairy Signal. Bye now.